All right, the market started the post FOMC week on a pretty neutral, relatively down, no, but very small volume, very small range. I think some people might be looking forward to what may be coming out tomorrow from Chairman Powell as they start to talk again after their quiet period ended. But it was a big week last week with the FOMC and jobs and earnings, and now we're kind of settling in. And the only thing we've got now coming up next week is the inflation data. But as of right now, we're just kind of trying to digest everything we got really in the last 2 weeks, which the market has responded to very, very well. Now it's a question of whether we can hold it or if it ends up being a fake out move like we've seen before in August. So I'm going to show you some charts here and see what you think. I'll give you my take on this rally that we've had in the last couple of weeks and really the kind of a breather we've taken the last couple of days and how significant it is, what's kind of driving a lot of this breather, and what we might expect going into the rest of this week. So that's what I'm going to share with you. We're going to take a look at some of the high-end risk asset and see what they're telling us, how bullish that they've been, and how, whether or not it's trend changing for them. And then we're going to take a look at a trade idea of a stock that's kind of followed the same trend to see whether or not we should chase it or what kind of trade we can do on a stock like that. So let's go ahead and get started. Today is Monday, February the 6th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you down there. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos. Come down here, click on the heart. It opens up this tab, hit that like button. Same thing here with this thumbs up icon. Open up that tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on Twitter and Facebook. So we really appreciate those who like these videos day in and day out, and you can do that right now while you're watching here by clicking on those icons. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, and you can see the 2-day decline. Not very much of a decline today. Very, very small range, about half the average. I think a lot of people are still looking towards Powell's speech tomorrow. About half the average range, two-thirds of a percent lower. The momentum line is down in oversold levels. Last time, the near-term line did not get down that low, and we'll see if it does again. Over here, when it was kind of ending its bearish run, it also had a couple of momentum drops to relatively extreme lows that the near-term line did not follow. And so we'll see if that ends up being the case again these last two times. You can see this one was just a 1-day decline, whereas this may be just a 2-day decline. The near-term line dropped to 41.5 there. It's down to 40 here, so neither one of them really significantly into bearish territory. And as of right now, easily almost 4% above 30-day moving average, so easily in dark green shading green line territory here with the intermediate line now above the 90th percentile, and market sentiment still falling, but at least in bullish. I mean, barely falling, and at least it's in bearish territory, or excuse me, still in bullish territory at the low end. So I wouldn't necessarily say this is a bearish divergence. Obviously, we got a much higher high here in the last couple of weeks compared to lower highs in the near-term line. So, and again, this time the near-term line exceeded the momentum line, which is not good. So there is that element, and again, the first target would be the low point of the in between the two divergent highs, and then of course beating that low point would be a change in trend. So definitely something to keep an eye on, that we don't play out that divergence there. Looking at the weekly chart, we are really getting in gear here. You can see the 10-week moving average is barely, but it is positive, so it is crossing above the 40-week moving average, and again, a higher high last week with a higher close, and as of right now, not a higher high, but at least a higher close so far, right? We'll see. Again, we're only 1 day into it. The MACD is back down below its moving average. Again, we're only a week into it, so we'll see how that plays out down here with the Hakinyasha differential. You can see in the past it typically leads to a reversal when you get below the moving average, and you get the bearish Hakinyasha candle. So Doesn't have to, but it is something that we need to kind of keep an eye out for as well. Looking at the 3 green arrow charts, obviously you have 3 green arrows across the board, except for the Dow Jones. The Dow Jones had a red arrow on Friday on the stochastics. It got a green arrow back on the stochastics today, but a red arrow on the MACD. So it's the only one. Everything else is dark green shading, or 3 green arrows, and has been. So obviously, easily a bullish intermediate trend has developed on these, needless to say, right? Looking at the 2-line versions of the chart, you can see the breakout. I mean, that's a good move all the way up to that that really important 50% Fibonacci line right here of the entire decline that we've had since the early 2022 high. Remember how important that is. At the time, it was up here, and that turned out to be a fake out. Remember at least, again, I've never done the analysis. I've only seen on Twitter somebody else who apparently may have done the analysis posted that once a correction has exceeded, once the bounce back off of a correction has exceeded the 50% retracement line of that correction, then it never goes back to new lows. Obviously, that was posted in August, and it went back to new lows. So in one time. But again, odds are, considering it's now only happened once ever, that getting above 50% could get us there, could get us up to new highs again. Unless it ends up being a fake out, which we only had 1 day above it. We're already back down below it. We're already back down below that 78% retracement, which is the trend changing line from being a bearish trend with a retracement to the upside to now being a full-on bullish impulse move. So again, we've so far have failed there. As of right now, you're also sitting below this important 23% Fibonacci line of the post-COVID rally. So breaking below that starts the retracement, which we have been. We got below support. But now getting back above that would end this retracement of the post-COVID rally, basically that market sentiment move to the upside. So you can see when we are on the verge of just like changing the trend from being what it was. I mean, consider now we've been pretty neutral since May. Since early May, we finished May 6th at 411, and we're at 409.83 right now. We were at 411 yesterday, 412 yesterday. So since May 6th, we've been pretty flat. Since April the 29th, we closed at 412. We've been pretty flat. Again, closing at 416 a couple of days ago and finishing at 412 Friday. I mean, that's a long period of time of not trending down or up. Of being sideways. So most of the bearishness was early in the last year, and it's not really been bearish, even though we have been getting lower highs and lower lows until here just recently. Let's take a look at some of these other oscillators here. Looking at the DMI for the S&P 500, again coming off of the cluster there on SPY, not an SPX, but on SPY we got the cluster. We are still very high overbought on the positive indicator. Though considering how overbought we are on the positive indicator, we're not very oversold on the negative. I mean, again, the last time we were up in these levels, the negative indicator is well below 15. Like, we're actually above 20. So, considering how bullish we are, we're not really that bearish on this negative. That's why your ADX can't get going, right? I mean, the positive is way up here. The last time the positive was way up here. Again, the ADX really got going. But like this time, the ADX couldn't really get going there. You ended up with a cluster, and we peaked. The question now is, are we going to end up with a cluster again and peak? The whole moving average, we did get a bearish candle. You can see the MACD is still above its moving average in terms of where we are relative to the whole. We haven't flipped the parabolic SAR over yet, so we haven't even turned the whole red. But you see just how close we are to a change in the trend. We have broken below the range. The range of where we are in the 4-week range has broken below the 20-day average of that range, which, as you can see in the past, can be a bearish signal there. Obviously, the money flow continues to the downside as we're almost back below 50 now in the money flow index. Again, I talked about how over here we were at 410.97. And we have since dropped and bounced back up a couple of times. and still are nowhere near that level on a volume standpoint. So we're still not getting enough volume on the upside to really support a bullish move. And you can see the money flow is already starting to wane. You also see the advanced decliners has turned negative for the first time in this cycle. So not only have we dropped below 35, which we did on Friday, but it's turned negative. So we did jump above 1,000, but we're already like starting to roll over. So we'll see if that ends up being a fake out. That doesn't necessarily mean that we're bearish, but it does mean that we might be kind of slowing down on this current bullish move. And this is just a matter of where the bullish move ends up. Obviously, we're still above 60. We haven't dropped back below 60, nor we are in the lower half of the chart. We are back. We're still in the upper half of the chart on the CCI too. So we're not, strong bullish levels, but we're still bullish on those charts. You still have an intermediate trend strength and well above the cloud. Strong 26-day rate of change. So everything's bullish from that perspective. It just appears like this current bullish move may be losing its strength and momentum. We're back into, where we kind of touched the 100, where we got to the 99th percentile. Never did quite close above the Bollinger Band, got right up to it. We did close above the Keltner channel, now only to come right back down, which is fine if we can get back above it. Like the bands are outside the Keltner channel, so we got green dots, but the momentum line is turning down. So it is losing momentum. So we'll see, how much of momentum we ultimately end up losing. All right, if you look at the 4-week range here, you can see we got a lower high and a lower low today, easily closing below yesterday's low point. You can see the volume really draping off as well. But what's interesting here is you got the high point here a couple of days ago, and again, we've done this before, and then we bounce right back up to new highs pretty much the very next day. So on this day here, you got up to a new high the next day. This day here, you got up to a new high the next day. You had a third day here, one more down day before you got a new high the next day. So if we're following the pattern, we'll get a new high either tomorrow or Wednesday. Or if we don't, then this keeps dropping towards 70. Once it gets below 70 is when, like here, you're susceptible to the jump to a new low point. And the low point is not very close right now, but it is going to jump up to, I believe right here, to 386.27. And then after 2 more days, it will move over here and come well off of that. So it'll be well off of that low point. But still, even there, you can see the range already as it is down pretty significantly. And it will go down more as this low comes off the table and we come up here. So it will make it that much easier if we don't get a new high in the next couple of days and this moves towards 70. You can see now how much easier it will be, because the low point will be the low of 119.23, which is right here. It will be that low point. So that will be the low and that will be the high after basically on Thursday, after the next 2 days. And so it gives you, you can kind of see just how susceptible you are, especially considering we haven't broke out. Now, we never broke out to the downside here and ended up being a higher low point. But if we never break out to the upside either, then we end up with potentially a fake out pattern, double top kind of fake out, which you would expect to go down to a lower low coming off of that. So really important that we get a new high in the next day or two to really solidify this move. Of course, like I said, today's volume and range was really, really light. 60 million shares trading, 3-point range. When you put those numbers in context, 3 points is way below it's half the average, and the average is pretty much near its 52-week lows. The volume was down here at 60 million, again, pretty much near the 52-week lows of its average in August. So needless to say, now we haven't broken below 1.5 yet on the ATR, so breaking below like 6 on the ATR will really solidify this bullish trend again, going to the upside there, getting below that 1.5% mark. If you look at the volatility index for today, of course, it's a Monday, so it means we go up. The markets were down a little bit, so it went up because of that too. It didn't go up very much. It's not back above 20 yet. It's still at 19. You can see the VIX ratio along with the VVIX is going back up too. So the VVIX jumped back up, is now at 85. You can see had a pretty significant jump on Thursday. But we dropped the next 2 days, so our correlation dropped back to negative again between the VVIX and the VIX, which again is not common. Those two indexes are highly correlated with each other over the course of time. If you take a look at this chart and I zoom out so you can see, over the course of time, this index is highly correlated with it. I mean, it easily spends most of its time up above 50%. In fact, if I were to change this correlation to this bar so you can kind of see it a little bit better, you can see it easily spends more time positive and it spends a lot more time above at 50% correlation than below it. So the fact that we've been spending so much time this whole calendar year, pretty much the entire calendar year, below 50%, again, suggests that we're setting up for a significant move. Generally speaking, when you have these negative correlations, you get a run in volatility to the upside. You get a run in volatility to the upside. You can see some of these others here. You had a run in volatility to the upside, a run in volatility to the upside off of those two. You can see over here you had a run in volatility to the upside. Over here you had a run in volatility to the upside. So all these kind of one-off correlation or negative correlations, which are very rare, even just being below 50%, generally leads to a move to the upside in volatility. And we just haven't got that yet this year, even though we were negative. And we're still at 50%. So again, the expectation is that we are, especially again with, and I've shown you this before, especially considering the seasonality of the VIX, which right now, this is the time of year that the VIX is strongly bullish. You can see it tends to go up pretty significantly. That's over the last 5 years. But even over the last 20 years, you can see it tends to go up pretty significantly here, up to about a 20% on average, 22% gain on average by the middle of March. And we're 15% down. So we are entering into a seasonally bullish time of year for volatility. So we have to keep that in mind. And we have to keep in mind, too, that volatility has been compressed, has really been compressing for the bulk of this past year. It's been below 10%, which is a really low number that typically we get down to on volatility spikes. But when we're down this far below it without the spikes, then again it goes to show just how much is compressed, relatively speaking, and that generally also leads to a run higher in volatility. All right, so now if you look at what's driving this market, you can see over the last 3 months, very strong moves in both bonds and stocks. As bonds are up here pretty high. Gold has been up pretty high. Bonds have been up pretty high. Stocks, both international and U.S. equities, have been pretty high. Corporate bonds have not, so they've been down. And you can see the dollar, of course, has been significantly lower for the last 3 months, along with commodities, which is not the common for both those two things. But having the dollar down, having yields down, having commodities down has been a recipe for bullishness, because that's been the problem. That's been the recipe for bearishness. The inverse has been the recipe for bearishness over the last year, right, in 2022. You can see the dollar making a run up to the 50-day moving average and its point of control over the past year. So the dollar over the last 2 days has made a pretty significant move to the upside. Looking at its two biggest components, the euro-US dollar, the euro is breaking its 30-day moving average. It broke the 30. It broke the 17 Friday, broke the 30 today. Starting with a small move so far up to the upside tonight. If you take a look at the U.S. yen, you can see it's up above the 17 and the 30 on Friday, and then up further towards the 50-day moving average with rising MACD and stochastics. So you can see how the dollar is making a little bit of a move to the upside, along with the 10-year yield. The 10-year yield on Friday and then today has jumped from being at below 3.4% all the way up to now 3.63%. So a significant move to the upside of the 10-year yield. In fact, getting back above 3.6% ends the retracement that we've been on pretty much since mid-October, which has been so bullish for risk appetite in equities. So I don't know necessarily if that's the pattern that we want to see. TLT, you can see, is hitting up against its 200-day moving average. It's below its 17-day. MACD and stochastics are falling. We're below the point of control. So there's some opportunity here for bonds to be a little bearish, for yields to run back up. If you take a look at the FOMC here, the 3-month is kind of flat. I mean, it went down a couple points, but it's pretty much flat. It's reflecting where the Fed funds effective rate is now. But the odds for rate hikes going into the March meeting, the next meeting, we have a 96% chance that we'll be at 5% at the next meeting. 100% chance that we'll get something. In May, we have a 70% chance that we'll be at 5.25%. And just to kind of give you an idea, like this number has really jumped up significantly. And it's back up above it. Like I said, it's at 70% today, which is another jump higher. Getting above 60 generally means it will get up to 100. So the market, the futures market is pricing in a move up to 5.25%. The 2-year bond market is pricing a move up. You can see it's moved up to 4.43%. That's a pretty significant change when just a few days ago it was at 4.26%. Actually, actually a little bit lower than that. Sorry, I cannot get over this cough that I got. That's why I didn't do the market outlook on Friday, because I've been basically in bed all weekend trying to get over this. But as of last Thursday, we were at 4.1% on the 2-year yield. Again, remember that the Fed just raised rates on Wednesday to 4.75. So to be at 4.1, it pretty much meant that the bond market was pricing in rate cuts. But now the 2-year is almost caught up to where in fact, there's not very much of a spread there anymore. It was here a pretty significant spread. The 3-month again has been at 4.7, a little bit below that for quite a while now. But when you're at 4.1, that's about a 55 basis point spread, which is traditionally very large inversion between these two short-term yields that are very closely tied to each other. Now you've got at 4.43 now, 4.68. You're looking at about 25 basis point. So you've essentially cut that inversion in half, but with the wrong direction, right? Not with the 3-year dropping with rate cuts, but with the 2-year rising, and for that matter, the 10-year yield also rising up to 3.62%. You can see the move that it's made in the last 2 days here, coming from the post FOMC drop to below 3.35% at one point, now up to 3.65%. So that's a significant move. It's having an impact on the yields. Yields are moving back up. Not the 2-year. The 2-year 10-year is actually still at its lows. But you look at, again, the odds of what was a rate hike now is pretty high. By June, you're looking at about an 80% chance for 5.25% by June. So either a 25 pause 25 or 25-25. Either way, you're looking at high probability that by the middle of this year we'll have 5.25%. Then you go out to the end of the year, and you can see now the odds of being at 5.25 are only 25. So that means there's 75% chance that they're going to cut it back down. But that was a high number. Like now, it's only a whatever that is, 60% chance that will stay at 5. But just a week ago, it was 21 a month ago. So the market had been pricing in multiple rate cuts, or at least one from 5% down to 4.75. But now dropping to 4.75 is actually a low probability. As the market moves up to 5.25. So the market's pricing in more rate hikes. It's pricing out the rate cuts that we had priced in later in the year, and that's why you see the yields moving up higher, and that's why again you see the bond market. It appears that the bond market is starting to believe what the Fed, is starting to pick up what the Fed's been putting down here lately, and it's starting to bleed over into risk assets as well. I showed you the dollar. You can see again, like ARK investments, which will be heavily impacted by renewed strength in yields, hitting its resistance level above the 200-day moving average at the point of control, and that's Fibonacci levels, and then stopping, right? And Bitcoin would kind of be in that same boat, hitting up towards that 17-day with the convergence going on, MACD below its moving average, stochastics dropping as we potentially move towards its 17-day or below on Bitcoin. And Bitcoin, you can also see too here. Let me activate this down to the low level here. And you can see you're basically at that 23% retracement of this decline since last March, coming from 48,000 down. Again, we started retracement when you get above it. You end the retracement when you get back down below it. You can see that if you go all the way back to its high before that, last November, when the Russell 2000 at 70,000, you're not even close to the 23% retracement of that move. I mean, that's how much of a decline you've seen in Bitcoin over the last year plus, and how much of really of an oversold technical bounce that was getting back up towards its 200-day moving average. But again, it's a reflection of high-end risk appetite, and it's been so bullish here in the last week, and we've seen that in like Carvana, and you've seen that in Bed Bath & Beyond. This high-end risk appetite, the meme stocks, ARK investment stocks, Bitcoin, as well as FANG stocks, all really blown up this year so far. I believe on hopes that the Fed will start cutting rates later this year, which is ironic because Fed cuts rates during recessions, and recessions are very hard on risk assets. But I mean, regardless, that's been the headline movers for this particular end of the risk asset scale. And then now it appears that might not be the case as the bond market and futures market are changing directions pretty sharply in the last couple of days. Let's take a look at the sector moves over the last couple of days. Like I said, it's been a big FANG move here lately. But if you look at just the last couple of days, or just today alone, so let's look at just today alone here. You can see, not surprising, that technology and communication services will be among your biggest losers. Communication service held up, materials dropped, utilities and staples rallied. And if I go back to the last couple of days, so this 2-day decline we've been on, again, staples, financials, you can see energy, industrials, healthcare, and utilities. So you've got your safe havens along with that side of the cyclical scale that's more associated with breadth with the Russell 2000, whereas your technology, communication services, consumer discretionary have really dropped pretty sharply. Between 2 and 3% over the last 2 days alone. And real estate as well. Real estate's been kind of dragged down. Materials, that MT trade that we did in our Market Outlook Live on Friday, really dropping even more, so benefiting. That was kind of the bear call spread that we did, really starting to work out there. If we take a look at the Market Watch tab and look at just the stocks that we tend to, you can see FANGs is really getting hit still hard, and Chinese stocks and semiconductor stocks, Intel and Taiwan Semiconductor and Micron. Nvidia was flat, Microsoft was down, Apple, Amazon, Google, all down. So all these stocks, Meta was down just 0.25%. All these stocks really moving sharply lower. Netflix and Disney also coming down. Banks did well. Goldman Sachs, Charles Schwab moving up. Some of these industrial names, Caterpillar and Deere, which have been so bearish. Honeywell bounced up today. Gilead is the stock that we've been bearish on here recently. It bounced up pretty nicely, up 2% today, along with some other healthcare names, United Health and Merck. Tesla really moving up to the upside. Some of these industrial names, though, are not so bullish, and one in particular that I wanted to take a look at is LMT. Let's take a look at LMT here. Let's pull up its chart first. Pull up its market forecast chart. And you can see, like a lot of other stocks, have been really bullish this year. It actually has a bear tag now. We've rallied. It had been bearish. It got clusters. It's rallied back up. Its intermediate line's rising. Not quite above its market sentiment yet, but it's rising. We're above the moving average by 1%. It's not quite, a significant amount, as you can see, but still a pretty decent move. And like I said, the bear tag, which can either lead to a bearish move to the downside or a continuation bullish move. It's kind of like, it's going to do one or the other from this point. This is the inflection point. A lot of times, this can be a good selling opportunity for people, knowing that if it continues higher, like another day or two like this, then you're done, right? It's easy. But if it continues lower, then you've got, potential lower lows coming off of a lower high, and you're that close to where your stop order is. you've got a good reward risk ratio on a time like this. But if you take a look at some of these other charts for it, it doesn't look that bearish. In fact, we've been pretty strongly bullish, only to have some pullbacks in the last couple of weeks starting to bounce up a little bit. So it doesn't look like it's set up for a bearish move. It just looks like it's on a pull. It has had a pullback, and then it's had a nice little bounce up to the upside. If I take a look at the 2-line version of this, you can see, like I said, it's up to the 30-day moving average here. But filling in the gap between 30 and 50, you can see you got a volume node up here above us, a couple of months worth of highs here, right around just under 500. But on the downside at 440, you've got the Fibonacci level, you got the 200-day moving average, you've got the point of control with this big volume node, major support down here with some pretty strong resistance above us. So that typically leads me to want to do a iron condor spread in a situation like that. So I went out to March expiration. I sold the 20 deltas. So at the time we sold I believe it was here I saved it. Oh yeah, excuse me. It was the 435 was the 20 delta when we did the trade. Now it's at 16. And then the 490 was the 20 delta when I did this trade as well. And now it's at 27. So the stock kind of bounced up here since we looked at it in our Market Outlook Live video. But regardless, you can see where the strikes are. So here's the trade here. Those same strikes, just going one strike away for risk management purposes. So position sizing full. And you can see those break evens are right there. So my break even, if we break above that blue line to the top side, we're breaking out. I want to be out of a neutral trade at that point. If we break below this line to the downside, then we've broken major support. I want to be out of it in that sense too. So either way, I've got some pretty good break even set up that would be only broken only with directional moves. And that point, it'd be very easy to get out. It would be very easy to know to get out at that point, and ideally at a loss that's $420 or less by the time that triggers. All right, well, that wraps it up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between the videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.